Investors, you need to stop trying to avoid losses. Too many new and even experienced investors go into the stock market thinking that they can dodge losses. So they'll put in stop loss orders to sell their positions so that it doesn't give them a loss. The concept seems simple enough. If you cut your losses in an investment early, then theoretically you could get back in at a lower price, putting the extra money that you had taken out at a higher price and being able to buy more at a lower price. However, does this outcome sound familiar to you? You go ahead and buy an investment. It sells off and triggers your stop. So you get stopped out and then it drops. You buy back in and then it drops more and you get stopped out again. Or you get stopped out and then you think the stock's going to go a whole lot lower and it doesn't. Instead, it rallies and it goes through the price that you stopped yourself out at. And now you're thinking, well, I don't want to get back in because I'd be locking in that loss. I'll wait for it to retest where I got out, and then it never does. Let's be clear. Cutting losses using stop losses is critical for trading, but not for investing. In trading, a trader identifies a catalyst of what they think a stock's going to do, whether it's after earnings or some other positive or negative catalyst that's coming in the future. If you aren't right, if your trade starts to go the wrong direction, you should cut immediately and even consider flipping the trade entirely, going from bullish to bearish or vice versa, depending on what you're trading. If a trader doesn't use stop losses to get out of a trade when it's going the wrong way, they could be in for epic losses and trying to do something called turning a trade into an investment, which you should never do. However, the flip side of that is also true. You should never turn an investment into a trade. And that's what investors who use stop losses are trying to do. Investors need to fully understand every asset they own and have complete faith in it. Because a sell-off is a buying opportunity, not a reason to cut your loss and try to get out of your investment. Many of my positions dropped significantly lower than where I initially opened them. For example, I bought Coinbase on the day of its initial public offering at $414.54. It ended up selling off more than 92%, not bottoming until under $32 a share. If I had tried to cut my losses in Coinbase, when would I have gotten back in? $200, $100, $50? Chances are I would have gotten stopped out, gotten back in, gotten stopped out again, and probably been too scared to even reopen the position, thinking that surely Coinbase was going to zero when it dropped below $40. However, instead of selling, I was adding all the way down. My last buy order filled at $40.88, and as a result, I was able to reduce my cost basis by 52.54%, down from where I initially opened the position at $414.54, all the way down to $217.79. When Coinbase started rallying with Bitcoin in 2023 and 2024, it easily exceeded my new cost basis, which was when I started to sell it. I started to trim the position and take profits. Doing so lowered my per share cost another 9.2%, down from $217.79 to $197.75. And this kind of story isn't limited to an investment like Coinbase either. The same thing happened when I opened my position in Tesla during the crash in March of 2020. I opened my position at $37.10, which was $556.49 at the time, because there have been several splits in Tesla since then. Tesla then proceeded to crash an additional 37% plus from where I opened my position. It didn't bottom until $23.37. At the time, that was $350.55. But instead of cutting my losses, I added at $24.73, $371.01. Then Tesla proceeded to more than double in less than 3 months from where I built my position, and I was able to start trimming it. I took all of my capital out at $65.79 in June 2020. And the reason for this is we had more than a double in less than 2 months. It's time to take the risk off the table. Even now, Tesla is my third largest individual holding in my flagship portfolio, but it has no capital risk. In fact, I have taken not only the original capital out, but trimmed profits out as well. So when I buy more shares of Tesla, I'm just putting the profits back to work. There's never capital risk in this position. I have dozens of similar stories to this across my entire portfolio. Usually, a position that I open does sell off significantly from where I open the position. So what I do is I build a buying plan. I did this for Boeing, CrowdStrike, Dow Chemical, Dutch Bros, Meta, Nvidia, Morgan Stanley, Roblox, Salesforce, Schwab, Shopify, Snowflake, SoFi Technologies, Twilio, Zoetis, and many, many more across my portfolios. Does this mean that my strategy of buying in stages always works? Not necessarily. Currently, both Canopy Growth Corporation and Rivian are down significantly from my cost basis. And it's possible that both of them could never recover. This is why risk management is my top priority. Before even opening a position, I know exactly how much money I'm willing to lose entirely. And I have made a buying plan all the way down to zero. Like a venture capitalist, I'm not looking at investments as trades. I look at them as holdings that I will keep for years, if not decades. As long as my underlying reasons for owning the stock remain intact, that's my investing thesis, then I'm not going anywhere during a market sell-off. Instead, I will add to the position rather than close the position and try to avoid the loss. As always, there's only one right way to invest, the way that works for you. My strategies have worked for me for decades, but it doesn't mean that they're going to work for anyone else. You need to find what works for you and stick with it. But make sure you pay attention to what your strategy is to ensure that it is actually working. And if it isn't, make the necessary adjustments to ensure that you do succeed for the long term. Learn more at getirked.substack.com.